Thank you very much. So I have the sort of unenviable task of trying to bring together all the strands of the presentations that you've had this morning to try and give you a picture about what all these global developments really mean for the outlook for trade and the overall balance of risks that we see both within and between the emerging markets and advanced economies. So I'll try and take you through that, but ensure that we have enough time for a panel discussion ahead of our lunch. And I should also say that some of my slides will be slightly different from what are in your printout, just to try and bring in some more of those sort of global risks. But I do know that Tony and his colleagues will make those slides available to you should you want those. So I think, I always think it's sort of helpful to just look at a bit from a sort of longer term perspective, but also to think ahead. So I think overall, on the outset, the sort of picture in emerging markets. So, I mean, obviously, we are expecting to see the sort of global recovery in some sense is in train. And I think you'll have seen from the presentations this morning that recovery is perhaps more established in the US at the moment than it is in Europe. But I think generally emerging markets have outgrown the growth in the advanced economies. But I think we're now at a situation where I think some of the economic risks in emerging markets are really coming to a bit of a crunch time. And I think we've seen that reflected in some of the volatility in financial markets. So what I'd like to do is to sort of unpick some of those risks and also look at the sort of overall picture in the advanced economies as well. So I think what we've seen since the start of the year is that the world trade and investment cycle is much more subdued than maybe we were expecting 6 months ago. And I think a lot of the reasons behind that is that we are seeing a bit of a stalling in domestic demand in some of the emerging markets. And I'm sure Yves took you through some of the reasons why there's more concerns over growth in China, which is fed through to slower trade growth throughout the rest of Asia. But I think you can also look at the sort of investment orders that we're getting from the US and Japan, which also shows that investment is a bit more subdued. And I think what we're actually seeing is that some of the sort of main drivers of growth in emerging markets are starting to not have some of the kick that they once had. So this overall growth in portfolio flows, which has helped to drive down interest rates in emerging markets, just doesn't seem to be translating into the overall growth in domestic demand and investment that we might have expected. And China is a very good illustration of that, where we've seen vast growth in credit, but more recently that just hasn't translated into the high investment rates that China's enjoyed over the past 10 years. And part of that is a specific policy choice to try and rebalance the economy in China towards higher consumption. But it also does reflect overinvestment in certain sectors and the fact that policy is becoming slightly less effective. And I think we can see that theme carried out through some of the other emerging markets. And I would say the other sort of main engine of growth in emerging markets, this rising middle class and the opening up of trade opportunities both within emerging markets, but also from the emerging markets to the advanced economies. Really, a lot of that engine is predicated on some crucial structural reforms and political stability in some of the emerging markets. And I think investors generally are getting a bit more nervous about some of the progress that we've seen on those reforms. So I think there really are some serious risks in terms of how things could sort of go on and go wrong, rather, and how some of that global recovery that we expect to see may not come to pass. And so sometimes we find it useful to just sort of think about it in terms of a sort of overall risk matrix. So you can think of here as the sort of baseline scenario where I think this is what most economists would say, that we do expect emerging markets to recover, for world trade to pick up. The US recovery is more grounded now. And even in Europe, while the deleveraging is sort of constraining the overall recovery in Europe, particularly with all the fiscal austerity, we are expecting to see a recovery in Europe over the course of the next year or two. But I think where things can go wrong is just this sort of issue about the weak transmission of some of the monetary policy stimulus in emerging markets and some of the structural impediments in the major emerging markets. And that really could have significant implications for global trade. And I think if we think about Europe, in some sense, the issues there really do all stem around the politics. I think in the sort of baseline case, there's enough political buy-in, I think, to the Eurozone that we don't think it's most likely that we'll see a breakup of the Eurozone. But there clearly is a risk that that political buy-in starts to crumble, particularly if high unemployment continues or increases even further. Some of that fiscal austerity could really become unbearable, and we'll see an increase in the sort of pro-exit parties gaining popularity and no real progress on the sort of banking and fiscal union. And I think the other sort of risk that we would also highlight, which relates to this issue about portfolio flows, is we're in a sort of crucial point in terms of the decisions by policymakers in the US, in the Euro area, and in Japan, in terms of, certainly in the case of the US, about when that quantitative easing starts to be withdrawn. And we can already see in the events of the past week or so just how jittery markets are in terms of the responses to what people at the Fed are saying, and they're really watching very closely to see what will happen in terms of the withdrawal of some of the quantitative easing. And I think the probability of some sort of mistakes by policymakers, perhaps overreacting to higher inflation, really could have global implications. And so you can sort of map those risk scenarios, if you like, just to give you just sort of some sense of the overall scale. So if we start from our baseline, if we saw a sort of a kind of coordinated issues across emerging markets, that could significantly lower growth. Though I think, obviously, if the Eurozone were to break up, that would have more damaging implications for overall world growth. Whereas if we see some mistakes by the major central banks, that will not only impact on GDP growth, but in that scenario, we're likely to get more inflation relative to what we might see at the moment. So I think just looking a bit, trying to draw across the major economies, looking at the overall increase in quantitative easing across the advanced economies. So this just shows the overall increase in the balance sheets. And this story is probably familiar to you, with the Bank of England being very active, and the Fed as well, whereas the Bank of Japan, as I'll come on to show, is only really now starting to get going, and the Eurozone has been more cautious. But all that sort of liquidity into the financial system has really helped to drive down the cost of borrowing across emerging markets. And that's not only provided some fuel to domestic demand, consumption and investment in the major emerging markets, but it's also given governments a lot more fiscal space through having lower debt payments and a lot more ability to spend on the necessary infrastructure. But I think it's crucially also added to the risks from rising property prices. And I'm sure this sort of chart is familiar to a lot of you, the very strong rises we've seen in property prices across some of the major Asian markets. And last week I was at the World Economic Forum in Myanmar. And just to give another illustration of how when you get a massive inflow of investment into an economy as it opens up, we were quite shocked going on a tour of some of the major properties in Yangon, that a two-bedroom apartment in Yangon, we were told, were going for prices of about $1 million US, which when you see the level of infrastructure in Yangon was really quite amazing. And I think partly reflects that the situation where you have a cash-based economy and you start opening up to all this investment, but it's chasing very few properties that are actually on the market. And it's also put a lot of pressure on exchange rates and the volatility of exchange rates, which is obviously crucial to the sort of prospects for trade. And I think you can make some sort of good contrast between the developments in, say, Brazil and India from this. So the sort of major story on Brazil over the past couple of years is the real, the appreciation of its currency has really put its manufacturing sector under pressure, and it's really struggling to compete. So in some sense, the recent sharp depreciation of currencies across emerging markets for Brazil is potentially good news and could act as a bit of a safety valve as long as it doesn't happen too quickly. But I think if you contrast that situation with India, there we have a country where inflation has been a lot more sticky and persistent, and so the depreciation there could have a much larger impact on inflation and limit the ability of the Reserve Bank of India to respond. But despite that sort of, I think the major issues and risks that we see in terms of the withdrawal of quantitative easing and how that might impact financial markets across the globe, I think it's important to always just remember why people do think that emerging markets will continue to grow strongly over the next few years. And so this just shows our projections for households with an income greater than $30,000 US. So particularly in these countries, that's when you would start to have a significant amount of disposable income. And obviously it provides good opportunities for businesses, particularly in terms of consumer products. And you really get a sense of the phenomenal rise where in China a couple of years ago, the number of households with this income level was just around 1 or 2 million. But by 2020, that's likely to increase to over 30 million. And I think that phenomenal rise in the middle class will drive the development of consumption in Asia. And it's one of the reasons why Asia will become a bit more of a self-sufficient trading hub, because a lot of the sort of final demand will be within Asia. So for instance, we expect over the next 10 years, the fastest growing trade routes to be between China and India and China, as we see more of the final domestic demand within emerging markets. And I think another sort of pattern underpinning some of the developments in trade has been what we've seen in terms of the rising wages, and that's a sort of shifting competitiveness. And I know this is a bit of a spaghetti chart, but I think the point to draw out is really just that wages in China have been really growing spectacularly fast, which reflects the fact that China has been moving up the value-added chain and enjoying higher labor productivity. But it is also the reason why sectors like the textile industry are now increasingly moving to countries like Bangladesh or Vietnam, where wages are a lot lower. And you can also see here one of the issues between contrasting the rise in wages we've seen in Brazil and its relatively weak competitiveness relative to Mexico, which has kept wages relatively low. And it's also another reason why the recovery in the US is set in train, because actually the manufacturing sector in the US is at now one of its most sort of competitive levels. And so that rising wages in Brazil has been one of the reasons why the sort of manufacturing sector really hasn't grown at all over the past couple of years. And so that sort of underpins how Brazil will need to diversify its economy and hope to grow the higher value-added manufacturing as well as the service sector when it can't always rely on oil and commodities. But if you contrast that with Mexico, which has managed to stay much more competitive, you can see how car vehicle production has really increased in Mexico, and it's becoming quite a good base for higher end manufacturing. And that also provides a sort of two-way support with the US, which can kind of tap on its sort of strong trade links with Mexico. So I think to sort of summarize some of the overall risks in emerging markets, I think we are expecting to see more of that trade shifting between emerging markets. But I think one of the major risks that we see is the rise of protectionism. And I think particularly in tough economic times, that is always a risk. And I'm sure most of you are familiar with the tariffs that the European Commission has recently put on solar panels and Beijing's response. And of course, there's always a risk that that could move into other sectors or sort of escalate. And I think it also sort of underlines the tensions, the political tensions within the Eurozone, where you've seen Germany has managed to be successful relatively in the Eurozone because it's been able to tap into the strong growth in emerging markets and really present itself as a manufacturing base to export to emerging markets. And so it's quite keen to kind of keep those trade links strong. But some of the other countries within Europe, like France, that are starting to struggle with their overall competitiveness are increasingly arguing for more protectionism. And I think on the, obviously in the developments in Turkey has just sort of shown how the sort of nervousness in some emerging markets in terms of the overall political risk and how some fairly innocuous demonstrations can start to change the whole sort of political outlook in a country. And particularly, as I'm sure Yves took you through earlier, so particularly when some of the economic fundamentals in Turkey are looking a lot riskier, that really has a chance to sort of spiral. So, I mean, this slide is just taking you through some of the mechanisms where you might see kind of a coordinated slowdown across emerging markets and the overall impact on world growth. But I think it's probably useful just to sort of highlight what we see as the sort of crucial reforms that might happen in the BRICS and where we think those may not happen. I don't want to go through all of them, but I suppose I would sort of highlight that in China over the next 5 to 10 years, in order to increase the overall level of consumption, it really needs to reform the financial sector. It needs to deal with a very high level of urbanization, and that will create the need for a lot of policy changes. But I think there are major risks and pressure points from rising corruption, environmental pressures, and inequality. And I think in India, it really needs to attract some more foreign direct investment. And what we're seeing at the moment, it's a difficult time for India because with provincial elections, the sort of the relative bargaining power of interest groups is quite high. And I think finally on Russia has very ambitious plans to try and increase the sort of business environment. And amazingly, Putin has said he wants to bring them from, I think their rank at the moment in the World Bank's ease of doing business is about 112, and he wants to bring them into the top 20, which is really quite impressive, but obviously will take a lot of reforms. And whether there is that political will, particularly if growth in Russia starts to stumble, I would raise some question marks. I just want to very briefly just sort of tie back to some of the advanced economies. And just going back to what I was saying earlier about the withdrawal of quantitative easing, obviously what we're seeing in Japan at the moment is they are the country who are really trying a rather bold experiment to increase their quantitative easing, to try and raise inflation expectations to get consumption and to get consumers spending now rather than later, and to try and get businesses to use some of their very large corporate surplus rather to spend on investment and really kickstart the economy. But I think there's a real risk that the government there may start to give up before the policy has had time to work. And I think it does highlight this issue that as we have this sort of withdrawal of QE, it has potential to impact both on the advanced economies, but also some of the emerging markets. And I think on the overall view on the US, I think the recovery there really is in train. And probably the situation there is a lot less risky rather, than it was a year ago. And a lot of that relates to the fact that they've just bought themselves more time in terms of the budget deadlock. Because the fiscal position has come out better than they were expecting, they now have at least until October before they need to really reach a compromise on the medium-term fiscal plan. But partly as a result, what you're seeing is the Republicans and Democrats are becoming more entrenched in their positions. So obviously the critical point in terms of the withdrawal of QE is we don't want to see a sort of repeat of a sharp increase in bond yields that we saw in 1994. But I think that's more of a risk than what we will actually expect to see, because I think some of the communication strategy by the Fed is a lot better. But I think the volatility we've seen in financial markets in recent days does cast some doubt on that. And finally, just turning to the Eurozone. As I said before, we think there really is a clear political desire to maintain the Eurozone. But you only need to look at the events in Cyprus to just see how easy it is for policymakers to get it wrong. And in terms of overall growth in the Eurozone, obviously the moves to create further banking and fiscal union is crucial. And I think partly because of what we've seen in terms of Europe and obviously the need for much greater fiscal austerity, unsurprisingly that's led to tax rises across the board. And this is just showing how much sort of VAT has increased in different countries across Europe since 2008. But I think in terms of the pressures on corporations, one of the things that has done is put more pressure on the corporate tax bill, or certainly more public pressure. And I think as corporate tax rates generally have come down over time, VAT has had to rise to obviously to offset some of that. But now that we see real household disposable incomes in many of the advanced economies under pressure, we're seeing a bit of a public backlash against some of the tax structures on corporations. And so that's adding another dimension in terms of business risk for different companies, just trying to know what their tax liabilities or their effective tax liabilities really are. So I know that's been a bit of a sort of whirlwind tour across both the emerging markets and the advanced economies. But hopefully I've managed to sort of draw together some of the themes from the other presentations that you've had this morning, and just try to sort of highlight some of the risks and opportunities for trade at a global level. And I really look forward to discussing some of those issues further, both with all of you and some of my fellow panel members.